On today's show, you'll hear investor perspectives on the COVID-19 impact on startup fundraising. This is Investor Perspectives. I'm the host of Investor Connect, Hall T. Martin, where we connect startups and investors for funding. It's the time of COVID-19. We're in lockdown looking to reopen the economy in the U.S. The virus has changed the way the world looks with empty streets, shuttered stores, and death counts rising. There are signs of flattening the curve, so we now look to the other side when the economy will reopen. I hope you enjoy this episode. Our guest today is Evan Cohen of Healthbox. So what is the short-term impact of COVID-19 on startup funding?
I think the short-term impact is a pretty negative one, much more pronounced than you might expect when you flip on CNBC. Going into the crisis, we had really strong investment activity. Based on some CB Insights data that I pulled, we hit record in private U.S. healthcare investments in Q1 with over $10 billion in funding. And, as the crisis has picked up steam in March and into April, deal activity has definitely soured. April deal value across, this is all venture deals, has fallen close to 40% on a value standpoint and deal count by 30%. And, most of the deceleration, I would say, has come in the seed stage. And then valuation has been particularly challenged in growth deals. While deals have still gotten done, many are deals that were in the market prior to the pandemic, and some of which were repriced to more investor-friendly terms. Within digital health, which is my area of focus, we've seen some pockets of immunity throughout this crisis period, largely built around virtual care enablement. So examples of that would be telemedicine, digital triage, remote monitoring, home-based urgent care, just to name a few.
Why do you think the seed deals are taking the biggest hit? I would have thought the later stage would take a big hit because they have more at risk. Revenue taking a hit, laying off employees, all those things, and potentially having to repivot. And at the seed level, that's easier to take care of, and there's less to pull back on.
Yeah, I would say that's a factor of volume, less so than the size of the financing. So from a deal activity perspective, I think you're just seeing a lot of earlier stage investors, angel investors pull out of the market, given just the conditions. They tend to be more susceptible to pullbacks in the market. And, what's happening from a macroeconomic environment standpoint, I do agree with your perspective, Hall, around growth stage deals. At the end of the day, those are deals that are going to be priced more aggressively and will be susceptible to changes in growth expectations. So those are certainly taking a hit. Primarily, those are the biggest impact sector from a valuation standpoint, where investors are asking, what have you done for me lately? And if the answer is not too favorable, investors are largely spending their time elsewhere, protecting their existing portfolio companies.
Well, to your point about volume, I've noticed that a lot of the lower quality deals are stepping out more quickly, not even making a go of it. So that may explain why there's a big drop in seed, is there's just a lot of not so great deals that were considering going out when it was a bull market, but when it's now a bear market, they're not even going to try. So that may be part of it. So what is the long-term impact of COVID-19 on startup funding?
Yeah, so I think my perspective is really centered on digital health here. In that case, I think you really need to think about the impact to the buyer. On one end, it's clear that the metaphorical digital chasm has been crossed, and health systems that are more digitally advanced have fared better in the COVID crisis. Digital health infrastructure has moved away from a nice to have to truly a need to have, which will ultimately promote an acceleration in the adoption of digital tools. I think the challenge here is that providers are strained financially due to underpayment for COVID cases, elective surgery deferral, and increased PPE spend. On the other side of the coin, you've got payers that don't have as immediate of a challenge because of that elective surgery deferral. And that's been a near-term tailwind. But longer term, under management of chronic care conditions will ultimately challenge payers, as well as the rescheduling of those elective procedures. Across each of those groups, the vendor hurdle rate to adoption is going to increase, but there's going to be plenty of business development opportunities for companies that fill an identified deficiency to each of those segments. I think the reality is, from a VC perspective, is that there is a ton of dry powder on the sidelines. And once there's better clarity on, what does growth look like coming into the fall and, maybe beyond that, there's going to be an impetus to put that money to work.
Well, help me understand. My impression that among the payers in the hospitals that there's quite a bit of legacy code still left and legacy systems still running. Is that true? And do you think the COVID economy is going to help move them into the next generation, true cloud-based applications that would let others connect into it and provide more digital integration? Do you think that's going to happen?
I think absolutely. There's just an incredible impetus. To my earlier comment, you can see those groups that have adopted those strategies are much better positioned to succeed in the current environment. And the reality is that the pandemic is going to be more than just the next couple of months. Health systems and payers need to prepare for an extended period of crisis. And, digital enablement, things like interoperability, are ultimately going to be a key driver to both financial and clinical success in this environment.
Our next guest is Kevin King of the Texas Halo Fund. So Kevin, what is the short-term impact of COVID-19 on startup funding from your point of view?
Well, I think that all of the startups that we are talking to are finding it extremely difficult to raise funding right now unless they offer exceptionally attractive terms. Now, having said that, we have funded 4 transactions since the stay-at-home orders went in effect in mid-March. So it's doable, but 2 of the companies that we invested in are portfolio companies already, and they're just reopening of previous rounds. So they're much more mature, but the valuation is still the same. So from our perspective, extremely attractive. And then one of the transactions an additional transaction to that is a follow-on investment, but not directly with the company. It was a situation where we were able to go into the secondary market and acquire some stock at a very attractive valuation. But we have done 2 new deals, so they're doable. But we are telling all of our portfolio companies, if it's possible, they should push off at least 90 days. Not because I think in 90 days it's going to be super easy to raise money, but I think in 90 days there'll be a little more clarity in the market as to exactly what's going to happen in the future, and maybe they don't have to have such an attractive valuation to raise the funds.
And so what is the long-term impact of COVID-19 on startup funding? What's going to happen down the road?
Well, what I think is going to happen, and this is really crystal ball stuff, but what I think is going to happen is I think you're going to see less frequent raises, larger raises, and raises for different kinds of things. So historically, we have seen this trend where the small businesses believe that they're going to raise again in 6 months, 9 months, a year, almost automatically. They believe that their valuation is going to go up every time. And I think that's going to pivot into a point where they raise less frequently and their valuations are based on objective metrics that they either have or have not been able to achieve. I think there's also going to be an emphasis on a faster path to profitability. And I think they're going to have to raise amounts to where they can maintain cash on hand to cope with unexpected and unanticipated circumstances. Now, the COVID coronavirus qualifies as unexpected and unprecedented. And I don't know that you could ever have predicted something like that. But I think the lesson that's going to come out of it is that you need to be able to maintain cash to the point that you can deal with more contingencies. So I think you're going to see larger, less frequent raises, more cash on hand.
My next guest is Rodolfo Dick, Managing Director at Prosa Ventures. So Rodolfo, what is the short-term impact of COVID-19 on startup funding?
Well, it's a tough one to answer. I think the impact will vary by market. By that, I mean by each geography and depending how deep the venture capital ecosystem is developed in each of the regions. But I think across the board, I would say it's going to be a difficult environment out there for startups. As we've seen in the past couple of months, the funds are focusing on saving their current portfolios, focus on the winners, what they're calling it. And at the same time, something that we've seen in the last probably 6 to 8 years, if not even the last decade, is that the funds have been investing at a faster pace. They've been deploying the capital faster. And what that has meant is that they have left a lower proportion of the funds for follow-ons. So meaning that not all other companies can and will be saved. And for startups, what this means is that if they're lucky enough to have strong investors and those investors are willing and capable of supporting them, they might do that and keep valuations relatively flat, or maybe use a convertible note or similar instrument to protect founder dilution and their investment at the same time. But if that's not the case and the company has to go outside to look for capital, then it's possible that they might run into a down round with some not so favorable terms, such as higher liquidation preferences, pay-to-play provisions, etc., because uncertainty is just too high right now. Also, we need to remember that the valuations have been riding high for the last several years. So many companies have a high price tag right now and little or no revenue to show for. So this puts them at a disadvantage to other companies. I think the ones that are in the strongest positions are the ones that raised funds in the last 6 months. They should be able to survive. They're putting in place good plans to have extended runway of up to 18 months to know how we're going to go or how we're going to get out of this COVID-19 situation. But for the companies that are currently raising, it's going to be harder environment out there.
So what is the long-term impact of COVID-19 on startup funding?
Well, here again, it's hard to give you one answer for all the ecosystems. And I'll touch briefly on Latin America, where that's another geographic area that we are focusing on. But in general, I think there's going to be a correction in valuations and what investors are looking for. We're coming from a long bull market, and a correction was already foreseeable pre-COVID-19, and this situation just accelerated that. In the previous recession in 2008, 2009, what we saw was a lag for the crisis to hit the private markets, probably about 12 to 18 months. So I think we're preparing for the same case in this situation where we're probably going to see some sectors being impacted relatively fast, like mobility, where we're playing right now, it's being impacted pretty greatly, as well as travel and leisure and some other sectors. But in the not so traditional sectors, not traditional, but like some other sectors like software or B2B services that you cannot see right now how deeply impacted they're getting. So it's going to take some time for investors to realize that and to apply it into the valuations. Having said this, I think the high levels of dry powder out there and the best opportunities will be able to find that money. Some sectors will benefit more than others. Some will lose hype, but like every crisis, it presents great opportunities. And those bold enough founders will be able to capitalize on them.
My next guest is Dan Kerr from Flyover Capital. So Dan, what is the short-term impact of COVID-19 on startup funding?
Well, so I think as the lockdown approached and markets really declined precipitously, there was initially, a very serious pause and a major look inward into existing portfolio companies. We tried to remain as business as usual as we could, but inevitably there was a lot of portfolio management going on, and different funds have pulled back to different degrees as they're trying to preserve cash and just giving their focus to their existing portfolio. I think that has, partially subsided, and firms have gotten their bearings. Many of them are considering themselves some degree of active, though I think it is hard to say that anybody is truly operating, business as usual at this point. Most people are not traveling at all. We have to take a degree of caution into any new deal. It's, you can't meet with the company. That changes the dynamic entirely. And there are just a lot of unknowns out there. So, we're continuing to work deals in the pipeline. I think many others are. It's a lot better if we already know the company and kind of can work through the process from that perspective. But, I guess I've seen some data that suggests that the majority, at least, of firms that invest in the middle of the country are at least looking at deals, considering new opportunities. So deals are still being done, although there's certainly going to be a pullback in the second and third quarter for sure.
Great. So what is the long-term impact of COVID-19 on startup funding?
Yeah, so it's really hard to say at this point. I don't think anybody really knows the final answer on that. So speculating, I think, is pretty dangerous. I think that, 2009, there was about a 60% drop off from a year or two before that. I would lean towards it not seeming like it is that degree of effect, but I also think we may not have seen the worst of the ultimate economic impact and how that can play out with VC investing in general over the next, number of years, really. So I think how I would take that question is to go through, if you take a negative view or a positive view. So the negatives right now is we could be in for a long recession. There's a huge loss of consumer demand going on that is just starting to play out. That's going to hurt a lot of companies, not just directly affecting startups, but their buyers. If they're in a B2B business model, there are bankruptcies lining up. And so I think we're only at the beginning of that economic effect, and that I think it's very likely to lead in some drawback in fund formation. There's a lot of dry powder out there right now, but as funds are kind of in the midst of raising and that sort of thing, they may be in a position where their LPs have less risk appetite and there's just not as much funding out there. I think it's also in 2019, which was in some respects a record year for venture, a very active year for venture. There was a lot of corporate venture capital that had come online. And I think that that's likely to have a lot faster pullback than VC funds, which are committed. So I think in total, there's going to be less investing activity out there. There's also, of course, virtually M&A and exits have come to almost a standstill. So that just reduces the capital that's out there flowing in the system and turning over and going into new funds, et cetera. So with all of those negative things said, there are some positives out there. Again, going back to there's a lot of dry powder. There's really all-time highs of dry powder sitting on the sidelines. I think 2019 had just heavier pools of capital in the weight than we've ever seen before. In time, that will need to get deployed. And, sharks got to swim, as they say. So I think that, be it fourth quarter or first quarter, you could see some backlog start to release, and there will be a lot of funding going on. One of the things we've been seeing is that, really premium founders that really don't have trouble raising money just are simply not going out to raise their round right now. They're raising interim rounds or something insider or on the sidelines just to not be in the market when they think that they're going to get a discount to their valuation or send a signal to the market that they don't want. So those kinds of deals ultimately will get funded, but a lot of those companies aren't out raising their traditional round right now. I think another potential positive is that, looking at 2019, there's definitely some froth in different parts of the VC market, and that if there is a silver lining here, maybe it is that it just kind of brings, sometimes the deals back to a sense of reality and, curbs enthusiasm for, business models that maybe aren't founded on good fundamentals. I think that was already happening going into the COVID situation. So I think this just acted as a catalyst to really start to draw that back. Kind of maybe one other thought is, given we are a middle investor, one of the things I've been looking a lot at is, how resilient are companies in the middle likely to be in this situation? I think, generally speaking, they don't raise as big a rounds, that's kind of crept up over time, but they don't. They operate a little bit more lean. Some of the data I have seen out there suggests that a lot of companies actually are some of them feeling very positive about their prospects during COVID. So there's some evidence that we're in a better position to endure in the middle. So hopefully, my hope is certainly that we won't cycle as dramatically maybe as some other regions.
My next guest is Yaniv Snor, founder of the Mid-Atlantic BioAngels. So Yaniv, what is the short-term impact of COVID-19 on startup funding?
So first of all, I want to put things in context because we are a life science angel investor group. So we invest exclusively in life sciences. So my responses might be very limited in terms of what they pertain to. So the first thing we did, and actually I think many other angel groups did, is reach out to our existing portfolio companies and to see if they need any additional money through this challenging times. And so what that did is it took any money that was usually allocated for new investments and put it towards shoring up and towards helping portfolio companies. So the short term was that some of that funding was allocated away from new investments and into existing investments. But I think that sort of that was sort of the first wave. The second wave is that we're beginning to see sort of a regular deal flow come back, even though the deal flow has slowed down in many ways. So, we don't see as many companies coming through. I think many companies themselves are suffering for a variety of reasons. So again, the life sciences, if you're considering clinical trial, more difficult to recruit people, more difficult to run a trial, et cetera, et cetera. If you're trying to bring a new product into a hospital, et cetera, it's either completely on hold, that sales cycle, or it's basically not happening, or maybe pushed later on. So all of these companies are experiencing these kind of inflation in their timelines, and we have to react to that as well. So I think also this short-term thing corresponds to what was happening at the end of the last year, where we were seeing a bit of a bubble. And we expected some of that bubble to burst, not in this way, but it was burst nonetheless.
So what do you think is the long-term impact of COVID-19 on startup funding?
So I think the first thing, as I mentioned, was this bursting of the bubble. I don't know if you get the emails or the press releases from the University of New Hampshire has what they call the Center for Venture Research. And they just sent out a press release that says that the angel yield rate, which is defined as the percentage of investment opportunities that are brought to the attention of investors that result in an investment, in 2019, their yield rate was 30.7%. That's unsustainable. It means a third of pitches get funded. Usually a more sustainable rate is about 20%. For comparison's sake, our group's yield rate is 2%. So again, you have to take all of my comments in that perspective as well. So we were seeing an unsustainable rate of funding towards the end of 2019, which we thought was going to perhaps burst. And it did. We thought it was going to burst because the market was going to sort of correct, but instead this pandemic came in and sort of burst it for us. So we do expect that in the long term, the companies that are raising money will be probably of a higher quality companies, more of the type that would normally deserve to be funded with a higher, with a more realistic valuations. The second thing is, and depends really on how long this whole pandemic lasts. And by that, I mean, how long is it before, the industry is able to find some form of a treatment that can reduce the viral load so that the pandemic becomes from something that kills you into just a quote-unquote regular flu. The longer it lasts, the longer it'll mean that, again, more funds will be used to shore up existing investments. I think investors will get shy. People will end up seeing smaller rounds, fewer investors making investments. And if they do make, they'll probably be smaller as well. So I think, as people don't feel comfortable, they're not going to be making as robust and optimistic as investments as you would otherwise see. So I think the year is going to be leaner, from now on. Also, what happens in the public market will have effect because some of the angels, people's private money is always tied up in that area as well. Another consequence, an odd consequence of this pandemic is that the lockdown has forced many events around the world to suddenly become virtual and free. So now I and many of my colleagues suddenly have, a budget and ability to travel, quote unquote, virtually to all of these events around the world. So our world is becoming, in a way, more global. I've been seeing companies from all over the world, from different parts of Europe I've never spoken to, and so I think a consequence is going to be that our business is going to be more global. We're going to have more reach because we're going to see, hey, we can actually do this from home, and reach a lot more people a lot more efficiently.
You think many angel groups are going to follow and be less geographically centric and more sector centric?
I think they will. I think that many people, in terms of geographic, I think those that have been pushed out of their comfort zone and feel comfortable with a new zone will absolutely expand geographically. In terms of sector, I think that still depends on the people that you have in the group. If you have a certain expertise in the group will gravitate to that and they'll invest based on that. So sector, I think, groups will maintain the way they are. But geographically, yeah, I do think that there'll be an expansion.
My next guest is Gary Trauner, Executive Director of Silicon Couloir. Great. Appreciate you coming back. Appreciate the last one we did and looking forward to catching up now that we're in the midst of COVID-19. Looking forward to getting your thoughts on the impact on startup funding. So let's start off with, what do you think is the short-term impact of COVID-19 on startup funding?
Well, I think it's pretty clear that COVID's had a pretty meaningful impact, and the impact has been reduced funding in a lot of ways. And I think there's an underlying, there's an underlying sort of foundation here that COVID has brought out that is something we need to talk about. And to me, that's fear and uncertainty. The problems we're having are that people are fearful of getting the virus, and people are uncertain about what's happening economically and frankly in their lives. And when you've got fear and uncertainty, especially in the business world and especially in the private sector, that's a recipe for trouble. So from our perspective, we've seen a reduced demand for funding, or at least a reduced supply of funding, let's put it that way. And even some reduced demand. Companies aren't coming to us quite as much right now. They're hunkering down. They're trying to figure out how to stay alive and what they need to do, especially startups. So I think that's number one, is recognition that fear and uncertainty are the things that we're going to have to overcome in this COVID crisis in order to sort of get back onto whatever new normal track we have. But I think there's also some other short-term impacts. Clearly, there's tighter requirements and more scrutiny coming from angels and from investors in general and the companies that they're looking at. Our view here and the people that we're talking to, I think there's two really big things, and they are, one, I'll say management. I've always said that most investors buy management when you're investing, but I think now the onus has become so strong on the ability of a management team or founders to be able to navigate incredibly rapidly changing conditions in uncertain times, that we know, the people we know are looking at that and saying, number one, we need to know that there's a management team there that's going to be able to deal whatever comes down the pike. And then the second side of it, I think, is balance sheet strength, right? I mean, cash is king. So I think before, where you might have been investing in some companies that maybe were slightly undercapitalized, but it wasn't such a big concern because you thought, well, maybe they can go back to the markets down the road. And, it might be easy to go back to the markets down the road, or not as much of a challenge. Now it is. So I know that investors that we deal with are looking for companies that, even if they're startups, even if they're young, know how to handle a balance sheet and make sure that they have that balance sheet under control.
So when you say that the investors are pulling back, how would you quantify that in terms of investors and dollars invested?
Well, our angel group, so for your audience, we talked about this the last time we were on. Silicon Couloir is not just involved with angel investing. We're a 501c3 nonprofit that basically helps entrepreneurs. Our programmatic offerings, we call it founding to funding. So we have everything from mentor groups that help companies, mentor them as they grow. We have boot camps for startups and for entrepreneurs, all the way up to an angel group. So we do different things. And we've pivoted. We're spending a lot of our time doing business crisis coaching and mentoring. And the demand for funding supply has kind of I wouldn't say dried up, but it's not as urgent. Like I said before, I think companies are hunkering down and trying to figure out, well, how do we do with what we've got? And so for us, I would say we've had, an 80% drop off in demand for funding from companies that we're in touch with. And the truth is, a lot of our investors right now are holding their powder dry because they want to see the things that they've already funded and how this is all going to shake out. And of course, we don't know that. And so it's had a absolutely significant and material impact, I think, on what we're seeing.
Well, absolutely. So, but in the same vein, what do you think the long-term impact of COVID-19 is going to be on startup funding? What's going to happen after the lockdown and after we get back to new normal?
Yeah, well, in Hall, sort of after is a big, it's a big if, right? I mean, we don't know what that means and when it means, and we don't know what new normal means either. But I think it's pretty clear that there are going to be opportunities, and the world isn't coming to an end. Even if we have to adjust to a new normal that's living with a virus, if we don't find a vaccine or a therapeutic cure, the world still will not come to an end. And clearly there are opportunities. And I think, we don't know the long-term impacts. We're a couple of months into this thing, and it's still, we don't have an answer, at least here in the United States. We don't have an answer right now. I mean, in terms of getting it under, it's not under control yet. So long-term, though, I think, again, two things. I think there's going to be a big distinction between winning and losing industries, and we have to figure out what those are, and investors need to figure out what those are. For example, apparel's taken a huge hit, clothing, footwear, you name it. And I think part of that is depending upon what your business model is. How are you selling things? Are you selling in bricks and mortar, where people have to go into a store with other people, or are you going online and doing e-commerce? So there are going to be clear winners and losers in that scenario. I think clearly cloud and technology are going to be they've been viewed as winners in the past, but I think that's only going to accelerate. And again, there will be new technologies and new creative industries probably that come out of this that we're not even aware of yet. And so I think it's a time to bide our time and say, don't get involved in industries where the impact is going to be longer term. And, wait and see where those new criteria that come out that help new industries or existing ones that are going to accelerate their growth, where those things going to happen. And then the second thing, so clear distinction between winners and losers, and trying to pick those and make that decision is not going to be easy, but I think that's one place. I think the other is I'll go back to the balance sheet. Clearly, cash is king. So one of the things that we did in Silicon Couloir here in Western Wyoming, where I'm based in Jackson Hole, Wyoming, is we put together sort of a cash management checklist for all the companies that we're involved with, both as mentors or with our angel investing group. And a lot of companies, I think, haven't really looked at, they know that cash matters, but it hasn't been life or death. And it's now life or death because they're going to have trouble going back to the markets right now during this time of fear and uncertainty. So the ability to manage your cash, to work with vendors, to work with suppliers, to find customers, I think that's the other big thing is every business needs customers, right? So when you talk about the long-term trends, looking at businesses that you feel have the ability to find and retain customers over time. And I know that sounds sort of simplistic, but I think it's not going to be very easy for some industries to do that. And so making sure that you invest in companies or find companies and industries where there's a stable customer or growing customer base is also going to be super important. That's why technology, right? Everyone's talking about Zoom. We're on Zoom right now. So, use of virtual meetings and technology that allows for distance working and working from home, WFH and all those things, you've got a built-in customer base and it's probably going to be a growing customer base over time. That's probably a good space to be in. Again, places where industries, the industries that have been the hardest hit are ones where fear and uncertainty have caused people to pull back. So restaurants, movie theaters, places, bars, places where you don't want to mix with a lot of people because you're worried about getting the virus. So it's a little convoluted, but I'd say long term, we don't know, but winning and losing industries, finding customers and making sure you invest in companies that have customers and then strong balance sheets.
Thank you for joining us today. As always, be sure to leave a review, subscribe to this podcast, and share it with others. Let's go start up something today. Halti Martin is the director of Investor Connect, which is a 501c3 nonprofit dedicated to the education of investors for early stage funding. All opinions expressed by Hall and podcast guests are solely their own opinions and do not reflect the opinions of Investor Connect. This podcast is for informational purposes only and should not be relied upon for the basis of investment decisions.